Hello YouTubers, thanks for clicking on my video. And seeing that you've clicked on the video, you're probably wondering why someone that's going to talk about personal finance and going to talk about investing is going to tell you not to buy individual stocks. So there's a whole reason behind why I changed from purchasing individual stocks to now focusing on buying index funds and ETFs instead. So before I get into that, make sure that you subscribe to my page so you can get updates for whenever I post a new video. Make sure you like this video because I know you're going to like it. You're going to like it. And make sure you hit that notification bell so that you actually get a notification on your phone or via your email so that whenever I make a new video, you'll be notified. When dealing with buying individual stocks versus buying an index fund is that there are more fees when you're buying individual stocks compared to purchasing an index fund. And I'll talk about the different ways you can get into an index fund for either no fee commission, no load fees, and just a very minimal expense ratio. So let's first talk about what I used to do. So I've been interested in investing for about, I'd say 10 or so years now, where I've actually been in the market. And, I consider myself a fairly smart guy. I actually like doing research. I like reading. So I would actually go and look, on the SEC website to look at the quarterly statements for different companies. I'd start with, the things that I actually purchase, whatever, my cell phone or the different electronics that I buy, the different social media platforms that I use, even the food that I buy or the restaurants that I go to. And I would use that as a basis for, the stocks that I want to get into. And so when you're doing that, there are a lot of platforms that they'll charge you between anywhere between 5 to 10, and it used to be a little bit higher too, just to buy an individual stock. So let's say you have $1,000 and there's a stock out there that's $100 per share. And so with that $1,000, you would think that you can actually buy 10 shares of that stock. So 10 shares times 100, that's $1,000. No, you would actually only be able to buy 9 shares because there would be some sort of fee with most of the investing platforms out there in order to buy exactly $1,000 worth of that stock. Now, there are a few platforms out there that actually don't charge a commission fee, and I'll talk about that later in another video. But let's say the average platform nowadays, they'll charge you around between $5 and $10 per share, not per share, but per purchase. So if you make one purchase of 10 shares of $100 stock, that's $1,000, and then they're going to charge you a fee on top of that. So that would be another $5 or $10 depending on that. So if you're doing that over a long period of time, let's say you're doing that one time per year. Yeah, that's only, maybe $10 or $5 per year. But let's say you want to buy more shares of that stock over time. You want to keep purchasing that $100 stock that, it may be going up. Let's say next month it's $105. So now you can't buy 10 shares because, maybe next month you have another $1,000. You can't buy 10 shares, but you're also going to pay another $5 to $10 in fees. If you're doing that every month, that $5 turns into $60. Or if you're paying $10 for every transaction when you're buying that group of stocks, now you're paying $120 per year. So you can see how that can add up over time. Now that's saying if you're only buying once per month. So you have that $5 or $10 per charge, per stock, or either per basket of stocks if you're buying more than one share at a time. That can really add up if you're actually continuously investing over a 5-year period, a 10-year period, maybe even a 30 or 50-year period. If you start soon enough, that money is going to add up over time. So with index funds, the fees for purchasing an index fund is actually over a long time period. Now there are some index funds and ETFs that you can buy where they will charge you a per transaction fee, just like they would when you're buying an individual stock. But there are no load and commission free ETFs / index funds out there that you can purchase, and they don't charge you each time that you put money into that index fund. So over time, if let's say you're putting $1,000 a month, well, let's say you're putting $100 a month, whatever the case may be, whether you're putting $100 or $1,000, the fee that you would have been charged for commission would have stayed the same, whether you put in $100 or whether you put in $1,000. Now with an index fund, they're going to charge you an expense ratio. Now that's spread out over the course of a year. So it's kind of like an interest rate. You can think of it like that, the interest rate that you may get on your savings, but you're actually being charged that as a fee. And so some of the lowest expense ratios out there would be a 0.03% expense ratio. Now the highest you would find would be maybe around 3%. Now you can see that there's a huge difference between 0.03% and 3%. So if you're just looking at it from looking at the actual decimal number, 3% is 0.03. A 0.03% expense ratio is 0.0003. So if you're putting $1,000, let's say for the whole year, you start at the beginning of the year, you have $1,000 that you want to invest in an index fund, and over the course of that entire year, that $1,000 is only going to cost you 30 cents in expenses. Now, if you were in an index fund that charged 3%, that would be a $30 fee for the entire year. So that $1,000 is in there for the entire year. If you have the lower expense ratio at 0.03%, you're only spending 30 cents to invest that money. Now, if you had bought that $1,000, you put that in at one time with something that's not commission free, you're charged either $5 or you're charged $10 immediately, and that's a one-time transaction fee. Now, at the higher end of the spectrum of index funds expense ratios, if it was 3%, you're spending $30. So that would be similar to making either 3 individual stock purchases with an individual stock or an index fund that actually charges commission every time you put the money in. That would be like making 3 purchases. But you can actually, over time, you can put in a little bit of money at a time. And if you only have a little bit of money to put in, that benefits you a lot because, each month I can put $100 in and I'm not being charged $5 then or $10 at that time. And, if I want to do that every month, I don't have to worry about those individual fees adding up over time. Now, so using the example of that $1,000 with that 0.03% versus the 3% expense ratio. Now, over time, because you're being charged that annually, you're being charged for the $4 amount that's actually in your account. So over time, if you're putting $1,000 in every year, let's say over the course of 10 years, so you're going to have $10,000. So we're not actually considering in this calculation any growth that you had over the 10-year period. This is assuming you put $1,000 in there every year for 10 years. There is absolutely no growth, which is unheard of. That will never happen. So let's say you have $10,000 and at the 0.03%, you're only being charged $3 per year. Now, if you're on the higher end where you actually have a 3% expense ratio for the year, now that's $300 per year. Now, if you had the choice between paying $3 per year to invest in the market versus paying $300 a year to invest in the market, I can assume that most of you would rather spend $3 versus $300. That's just me. I don't know. I assume that, you don't want to do that. And I'll get into it later as in, the differences or, the research behind why, paying $300 for that higher expense ratio with the assumption that when you're paying that higher expense ratio that there's going to be a greater return in that index fund versus the one with the lower expense ratio. Chances are it's not going to be, one, it's probably not going to be higher, and 2, it's not going to be that stark of a difference to where you're actually benefiting from that higher expense ratio. Now at $100,000 in your account, let's say 10, 20, 30 years down the road, that 0.03% expense ratio is only going to cost you $30. Now let me remind you, when you only had $1,000, a 3% expense ratio costs you $30 per year. You now have $100,000 in your account, and at 0.03%, now you're paying $30 per year. So Would you rather pay $30 per year once you're at the $100,000 mark? Or do you want to pay $30 a year when you only have $1,000 in your account? And that's $30 every year. As your money keeps growing, that's going to get higher because you're going to have more than $1,000 in your account. So if you have $100,000 in your account and you're paying a 3% expense ratio, you're now spending $3,000 per year for that same index fund just because you have more money in it now, and because you decided to pick an index fund that's 3% versus an index fund that's at a 0.03% interest rate. So now that you know that there's a stark difference, especially once your money starts to grow, what would you rather do? Would you rather spend less money per year to invest in an index fund? And if you're selecting a total stock market ETF, which is investing in all the stocks that are available, no matter which index fund you choose, if they're all the total stock market, they pretty much have the exact same companies in it. So it's really how fast or how soon or how often the manager of that fund is adding different companies that are publicly traded companies to that index fund. So unless you're picking some really specific index fund that's maybe, dealing with technology, or maybe it's specifically for the S&P 500 or whatever the case may be, there's really no reason to pay higher expenses. If you don't have the time and you don't want to spend the extra money, it takes a lot of time and research to actually pick a stock that's going to do well. And the purpose of picking an individual stock is to try to beat the market. If you wanted to just get the market return, obviously you're going to buy an index fund, you're going to get the total stock market ETF or index fund, and you're just going to get the market return. So if you're buying individual stocks, you have the hopes, because it's a hope. Of course, if you're doing your research, it's a little bit more than hope. You're still hoping, but you've maybe limited your risk based on the amount of time and the amount of research that you spent in selecting the stock. So that's going on the sec.gov website, and you're looking at the quarterly reports. You're looking what other professional investors, and right now I'm not making suggestions for someone that's a professional. Maybe if you're a professional, you should probably do this as well. But if you're not a professional, you don't have the time because you have a day job. These professionals, their day job is to research these stocks. You're working wherever you're working. Maybe you do customer service. Maybe you do research in another area that's not dealing with investments. Whatever the case is, whatever your job is, if you're a nurse, you're a doctor, you don't have the time to take, and you probably don't want to spend your free time doing research on individual stocks. So you might as well just put your money in an index fund and put it in all of the stocks that are available in the stock market. This video is going over 10 minutes, so I've decided to split this into two parts. So in this first section, I spoke about why I changed my philosophy. We also spoke about the difference in fees when purchasing individual stocks versus purchasing an index fund, and also the differences between a lowest expense ratio index fund versus some of the higher end expense ratios, and how that can save you money over time, and that can deplete some of the growth that you could have had if you paid less in expenses. With that said, let's go ahead and click that subscribe button so you'll be able to see part 2, and you'll also be able to see any other videos that I come up with in the future. Click that like button because you like the video, and also hit the notification bell if you want to receive an actual notification on your phone or your email whenever I create a new video. Part 2 will be coming up soon. Also, make sure you subscribe or follow my Instagram page, my Facebook page, and Twitter. I'll put those links down in the description. And make sure you catch part 2. We'll go into some of the books that I've read that help confirm my decision, and also taught me some new things about why, investing in index funds is the way to go for 99% of the people out there. Thanks for watching, and I'll see you in part 2. Thanks. Have a great day.